All right. Thanks everybody for coming out to our monthly webinar. We have some great topics today to go over, and as always, hopefully these are informative and add some value to everybody's investing and development careers, as it's obviously a very dynamic world that we're living in today, and always good to have information from different perspectives and different people doing different things. Quick update on the market as we're seeing it. Adam Riddle, Nexus Commercial Realty. We are brokers in the existing multifamily space and ground up development land. We are very busy. We currently have 40 properties under contract, and that's ranging from development parcels to larger apartment projects, value add to stabilized Class A low cap rate. So I think we're seeing a tremendous amount of activity kind of running the gamut of the spectrum of what we do. Obviously, debt, I think, is a big driver of that. Debt is still very cheap. I think pent-up demand for capital that all took kind of a break maybe for 60 or 90 days at the onset of COVID is coming back, and they're coming back with a vengeance, and they had a certain amount of capital they would have liked to have gotten out the door. Just a recent example of kind of the way the market is. There was a legacy asset of a long-term owner came on the market on the west side of town. I think it was 48 units, and within 7 days they received 14 offers for a property that was probably a sub 4 cap on their actual numbers, and a lot of them all cash and over list price. So that just kind of tells you a little bit about where the market's at today. So with that, today we were talking more the development side, which we have been doing a lot of in the past few years. And so we've got a few special guests with us to kind of talk through that. And we'll let them introduce themselves. Tyler, you want to go first?
Sure thing. Thanks for having me, and hope everybody's doing well this morning. Tyler Sibley, Cairo Residential. Just a little bit about our firm for those that might not be familiar with our brand. Based here in San Antonio, second generation family firm, been in business about 35 years. Do have regional headquarters in both Austin and Denver. We recently relocated our Denver headquarters to the Cherry Creek area, and so excited to get that open and operational with our team there. About us, just from an investment perspective, fully integrated multifamily management, investment, and development firm. Do own some hotel assets, unfortunately, across the southern Sunbelt states, but for all intents and purposes, we're core focused on multifamily operations and investments. From a footprint perspective, our development reach at this point is the 4 major Texas metros, Denver, Charlotte, and Nashville, working to get out to Phoenix and Southern Florida, Orlando area specifically, but have had a tremendous run with all of our Denver developments that started circa 2013 with our project in Golden Triangle called Jewel, now called 1000 Spear by Windsor, and have since piggybacked that into 2 other projects that have completed, both light gauge steel prescient buildings, one in the Rhino neighborhood called Edison at Industry, right there off Brighton Boulevard next to the Industry office building, and then a third project that we've just put the bow on in the Uptown neighborhood, Park and 17th, right adjacent to St. Joseph's Hospital, a 190-unit building on top of about 15,000 square feet of retail space. In terms of what we're working on currently there in Denver, we're under construction with 2 suburban deals, one up in Westminster at the Orchard Town Center. We're about 2 weeks away from opening the clubhouse on that, so really interested to kind of see how the market receives suburban product, just in light of some of the tabloid blotter about the mass exodus from the urban core into the suburban market. So we'll have some real-time data points here over the coming months, just of how that 270-unit high-density service park product is being received by the market, and so we're nestled up against the Orchard Town Center shopping mall. So interested to get that one online and operational, and then a couple months ago closed on another basis play workforce housing deal up in the city of Brighton at the corner, northwest corner of 50th and Bridge, across from the King Soopers up there in Brighton. a 315 unit, 3-4 story walk up type project there. So we're certainly active and view, this kind of, unique period of time as kind of the start of the next cycle, so to speak, and are interested in speaking with you guys more about that here this morning.
Perfect. Thanks, Tyler. Andy?
Yeah, thanks, Adam. Appreciate the opportunity. My name is Andy Schlaug. I'm the CFO of Mainspring. Mainspring is a Denver-based firm. We are a family office-based firm that invests in real estate and other businesses. So we're a little bit different. Actually, we'll present quite a different picture or perspective from Tyler's company. We don't have institutional capital or insight to those kinds of markets or products. So very different end of the spectrum. We're primarily driven by a long-term ownership mentality with the goal of social improvement in our projects. And so, that really means we look at projects and make decisions much differently than most or many, if not most, of our real estate development investment peers. We're primarily urban infill, central Denver and surrounding central neighborhoods. We're what I would call opportunistic, but not in the institutional definition of that term. It's for us, it's if we find an opportunity that we like, that meets our economic and social criteria, we're likely to do it, whether it's something we've done in the past or not. And so the result of that is that we have a pretty diverse project and investment portfolio. We own land, we own and operate retail and office assets. We've developed condos, we've developed single family homes, and we own and operate businesses like coffee shops and bars. So like I said, it's we're quite a different animal than an institutional investor, but hopefully we can provide some perspective on what folks like us are looking at here in the Denver market.
Yeah, perfect. And as Andy and Tyler and I spoke a few days ago, kind of the reason for bringing the different people on, such as Andy and Tyler, is because they are on both ends of the spectrum. And I think that's important because obviously Tyler's on the, 150 a door plus, maybe even 200 a door plus development and in multiple markets and a fairly large player. And Andy's more of a local developer and has a niche of what they're chasing and not solely multifamily focused. So that's kind of the reason for the two guests this week, because I think we'll hear some different answers to the same questions because it's just a different animal than both of you are dealing with. And so excited to hear some things. First, I guess, Tyler, this is for you. It sounded like in 2013. I actually remembered when you guys entered the market, but obviously a Texas-based company. Why did Denver get on the map for you guys?
Yeah, great question. So, Denver, in our view, is really a tier 1.5 city that, has emerging trends and just macro tailwinds, associated with the airport, the employment story, the lifestyle elements, just the corporate attraction and really just the business environment that really all checks the boxes just from a big picture standpoint that is really intriguing to us. A lot of parallels to Austin, which is where we're most heavily invested in currently, between Austin and Denver, just as sister cities that, really over the next 5, 10, 15, 20-year period are going to continue to generate, high earning, high paying, stable jobs, right? That, have the progressive minded employees that, really we hope occupy our buildings. And so, that coupled with, Denver is just an exceptionally difficult market to execute in, whether it be just the challenges associated with, going through the entitlement and permitting process with the city and just the multiple steps and, just the duration associated with, appeasing, for lack of a better word, just the city agents that are responsible for allowing you to go build what you think you can build. And then ultimately, just the management of the contracting process and how exceptionally difficult it is to, navigate those waters just in light of just the hyper-constrained labor market in Denver. All those things are actually appealing and intriguing to us. simply because if you can, go about, navigating those waters and successfully managing the process and, risk managing just all the different factors associated with going to build a, $100 million building, you have an opportunity to really, create a really unique and special, building in a neighborhood that, residents want to pay, top of the market or sub-market rents for, which is really our general MO from a business plan perspective. And so those elements coupled with, just really favorable property tax dynamics, with the Gallagher Amendment and just what the relationship to, multifamily residential, property tax burdens are. It's about a third of what it is in Texas and some of the other markets that we've invested in. And so, we've studied extensively via white paper and other research about, just those profound impacts on both, net values and also just cap rate, compression over the, foreseeable future. Those are the different dynamics that really appealed to us about, really pouring into Denver as a core market for us, and a market that, if we had, 5 new development projects, in the pipeline, I'm sure my partners would look at me and say, hey, why don't you have 9 or 10? So we certainly feel strongly about the market and believe that, there's something to be had, in terms of, some of these saltwater gateway cities, and just the de-densification of those areas and just what it ultimately mean for, some of the non-coastal, tier 1.5 cities like Austin, like Denver, like Nashville. We started to see that a little bit, at our Edison project in Rhino, where about 40% of our traffic, a little less than that, was either from New York, Chicago, or California, right? And just how does that trajectory accelerate or hold firm and really look over the next, 1, 3, and 5 year periods, just as Denver continues to move into that maturation phase of, institutional investment and lifestyle type cities. So those were a couple of the things that really appealed to us initially when we entered the Denver market and have only been bolstered, over the last, 7-8 years.
Yeah, no, that's great. I have a lot of follow-up questions to that, but I've got a question for Andy real quick. So you guys obviously are very infill focused. Can you speak to in business? It sounds like in businesses and in your real estate holdings. Can you speak to why that started that way, and has there been any talk of maybe broadening that at all?
That's a great question. We believe in the just the core fundamentals of urban markets and density, and that kind of the impacts that it has to livability and sustainability. So that's our primary focus. That's where we want to own property long term, and so that really drives our investment criteria, and both for real estate and businesses. We have looked at some opportunities and are actually currently pursuing some opportunities that are more exurban or even rural. But those are projects that are more driven by that social impact criteria that I mentioned, rather than longer term investment criteria, although there's certainly long-term investment underwriting that we go through with those projects to make sure that we believe long-term in those markets. So yeah, we're looking at some projects outside of Denver, but primarily are focused on the core markets because of their long-term, the long-term focus that we have, and how that aligns with where we see long-term value creation.
Sure. So we talked about this the other day, but I thought it was interesting. So you guys obviously have businesses, you have commercial assets, kind of spanning the spectrum of commercial real estate. Just talk a little bit about how COVID has affected some of your real estate and businesses, and has that made you your team more gun shy on doing another project at this point, because you're kind of trying to stabilize what you currently have, or are you still out there aggressively looking for the next opportunity?
Yeah, that question has a lot of sub parts to it. So I'll try to, if I forget some of them, let me know, or I'll come back to them. But in terms of COVID and the impacts to our portfolio, as I mentioned, we own bars and restaurants, and COVID has significantly impacted those operations. For a while, we completely shut them down. We agreed from the get-go. We committed to continue to pay our employees, so we kept them all on payroll and went through the whole PPP process. But we're committed to our employees and to trying to make things work. And we've opened up three of our four retail locations and are operating. We're obviously impacted significantly by just the numbers of in terms of foot traffic to those businesses. So we're somewhere in the 50 to 70% of our budgeted and forecast numbers for where those projects should be right now. And it as a tenant or as a landlord and a tenant, someone who's on both sides of that transaction, I think we come at it with a little bit of a different perspective. We're in buildings where there are more institutional owners, and we haven't seen the flexibility as tenants that we think is deserving, especially of small retail tenants. I think a lot of landlords pay lip service to the fact that they want the coffee shop, they want the bar, to generate that sense of place within their buildings. And even if you're a very, very small percentage of the building's overall occupancy, and therefore, some of the expenses and the pass-throughs and whatnot, when it comes down to it, what really impacts small business, especially during this time of COVID, is cash flow. And so we've tried to work with institutional owners on that recognition, and recognizing that it's extremely tough for any small business, but particularly for businesses that rely on foot traffic right now. And so while it's been difficult as a tenant, the way we've approached that as a landlord is much different. We do have small businesses who occupy our retail and office spaces, and we've been very flexible with them in terms of providing them with room to try to continue to make payments as they've been as they've had the opportunity. And we gave them a long period of time. We negotiated with our lenders to try to give us breaks, and we basically just passed those through it when we had opportunities to not make payment on debt. We allowed our tenants to not make payment if they didn't have to. So again, I know you had.
Did you guys take a break from looking at deals for a while and back at it, or were you always kind of out on the hunt throughout this whole thing?
Yeah, no, we've been through a number of real estate cycles collectively, and I would say that we did put one project that was a hospitality project on permanent hold as a result, because we just didn't think, given kind of where costs were, that coming out of the ground with a hospitality project would really be a good long-term opportunity for us, given that at some point we figured that there will be distress in hospitality, and it'll be cheaper to buy rather than build. Other projects, I would say, were kind of similar in that we see, as a long-term, very patient investment company, I think there will be distress coming. We haven't seen distress. There's been a lot of free money in the market. There's a lot of money on the sidelines, as you mentioned. But when I'm convinced that the distress is coming, and just because of the way that our real estate market works, that distress takes a while to flow through the system. And so, we'll continue to kind of patiently wait for those opportunities as they come. We're probably less looking for new opportunities now than we otherwise would have been.
Okay, cool. Tyler, I got a two-part question here. So you guys clearly started in more core urban areas. Why the shift to some suburban sites? And you're actively buying a couple of deals right now. Are you expecting and or seeing any discounts on those?
Yeah, certainly a topic that's kind of swept our industry, right? Is what are the permanency aspects of COVID, and does this whole mantra of live, work, play that we've kind of convinced ourselves to believe is the future forever of the industry, both in terms of office, retail, residential, hospitality, all kind of coexisting in this urban ecosystem, right? I think by definition, we're generally urbanistic in nature. I mean, that's really kind of what we've developed a reputation of really executing on, is really hyper complicated mixed use urban infill type projects that are either stuff in retail and multi together, or office and multi together, or all three of those kind of meshed in one vertical building. However, in Denver specifically, right, really a couple years ago, we noticed, the startings of, trends that really, we're pushing, rents upwards in the suburban areas, specifically, on the north, west, and some of the southwestern suburbs of Denver, right? And so, we're not ready to completely punt on the theory of, people are going to just, not ever take the light rail, into downtown or to the airport again, or out west to Winter Park. We think that there is going to be some type of blip in the radar, so to speak, of folks that are in that renewal phase, and hey, instead of paying $2,000, $2,100 a month for a 5 to 10 story building in Golden Triangle or Rhino or Uptown, right? I can go out to Westminster and pay $1,700 a month, right? Live in a lower density environment, have a great view, have an unbelievable pool experience, still have some of those urbanistic, walkability type traits, and, really get the best of both worlds while giving myself a raise just from a rent expense perspective. And so, we're certainly still evaluating a tremendous amount of urban infill opportunities, and, think that, really the pressures on, construction cost pricing in those urban infill areas are much more dramatic than what we've experienced out in some of the suburban areas, even pre lumber escalations here that we've seen over the last couple months. But, we've seen suburban rents outpace urban rents, really over the last 3 to 4 years, in the Class A new development space in the Denver MSA. So we're certainly active in the urban core in Denver, and would certainly still do, projects in and around the urban core, but certainly have a keen interest on everything that's happening in the suburbs as well. In terms of the deals that we're pursuing on the development side, we're starting to see, some more sense of reality from, landowners, land sellers, just with the simple economics 101 of, rents even pre-COVID in the Class A space, or, call it plus or minus 1%. Construction costs, taxes, insurance are, escalating, upwards of 25, 30%. I mean, that's pretty simple math to do on a annualized basis year over year. Of rents are growing at 1%, expenses and load is growing at 30%. It takes no genius to kind of figure out, that those are really competing interests there. And so we've started to see some sellers, get a better grasp on, the realities of, hey, land obviously isn't worth as much as it was, pre-COVID. And if I'm interested in selling this land in the more, immediate near term, I'm going to have to really take a strong look about, taking a little bit of a haircut, so to speak, on, what I'm willing to transact my property on, or, simply wait and, see if the market rebounds, and is that rebound a 6 month, kind of trough to peak, environment, or is that going to be a more multi-year type endeavor, right, where you're, sitting, trying to time the market and simply waiting for the market to recover. So a lot of different, perspectives just on the land seller side, but we are seeing, some of these owners of property that we're interested in pursuing development on really take a strong look at, making that tough decision and saying, hey, let's go ahead and, start this process now. Extremely confident that you guys are going to execute on this, but, let's go ahead and start the clock and move this forward.
Perfect. So some things have obviously shifted in since the COVID landscape. Andy, have you guys had to do anything, kind of retrofit any of your properties with more filtration systems? Is that becoming a standard from any new tenants that potentially want to come into a building? If you're looking at, a new project, is that something that you're paying more attention to? Kind of, what is the new standard going forward that you guys have continued to talk about in your shop?
Yeah, that's a great question. We have actually started to retrofit some of our HVAC systems. In our particular cases, tenants are primarily responsible for maintenance of that equipment. But in spaces that we own and operate, we're looking at various technologies like ion technology that can help reduce particulate matter in also, that includes viruses and some other stuff. And I'm not an expert on the technology, of course, but we are starting to do things like that. And the rest of it, the rest of what we've been doing is, probably the same kind of thing that everybody else is doing in terms of additional cleaning, additional expenses related to having wipes on hand and having hand sanitizer on hand, at the entrance and everywhere else in our spaces. Yeah, I mean, I think in terms of our own systems and our own properties, we are looking a little bit more intensely at HVAC and air circulation.
So Tyler, I'll ask you that same question, but I'll also add on, amenity packages. Obviously, you guys are building large buildings with multiple amenity packages. So if you want to talk about HVAC and maybe, what amenities are becoming more important and what amenities are becoming almost obsolete throughout this.
Yeah. All again, transcending conversations as part of our industry right now. And I think probably, overarchingly, our firm position at this point is, we still think it's a bit premature to make wholesale decisions to either programming or, infrastructure investments based on, what may or may not remain, over the next, 6, 12, 18 months after COVID, is at bay a little bit more. So, perhaps others will be a little bit more aggressive in terms of, upsizing or, incorporating elements to their infrastructure programs and programming dynamics to, really plan around a permanent world of COVID moving forward. We're not quite at that stage yet. I know a lot of our peers in the industry are going back to, the 1.5, where you've got a bonus room and a study. And we certainly have some of those, throughout our communities, but, we're not, having serious conversations about taking those from, 2 or 3% of the total unit mix up to, 5, 10, 15%. We feel like those are, conversations that are still a bit premature. In terms of other programming related measures, we've been doing these, call it quote unquote WeWork spaces, really for the last 2 or 3 years now, pre-COVID. And we're taking the work from home spaces a bit further by way of, having individually programmed rooms as part of that WeWork space where you can go either rent, by month, by week, by day, whatever it may be, these dedicated, private conference rooms that allow you to, have a presentation, take private phone calls, have conference calls just, throughout a week, or just, simply add that as part of your monthly rent, for the term of your lease, right? So we're doing about, 1 or 2 of those, per 100 units, in our communities. And again, not planning to change the depth of that, programming investment, for new projects, but, think that, we've certainly seen an uptick in, folks working from home and looking for those, individually dedicated space that has, high speed internet, has coffee, and ultimately has a quiet place to make calls without being disrupted by kids or dogs or whatever it may be. On the infrastructure side of things, we again have not, started to study, any, air purification systems or other mechanical upgrades at this point. Again, maybe right, wrong, or indifferent. We have kicked around some ideas related to, lighting technology that, purportedly, helps with sanitation and just overall, just disinfectant, characteristics. Again, kind of goes back to the conversations about costs and rents and the relationships, the divergent relationship between those two primary variables, really, difficult decision for us to say, hey, let's go spend another, $250,000, $300,000 on our lighting package to, be able to go market our building as, quote unquote, disinfected when, rents, aren't there to support that level of investment. But again, something that we're closely monitoring, right, as we kind of continue to get more and more familiar with what the staying power of COVID and the impacts of COVID may or may not be.
Yeah, that's great. So these are probably, we're going to get on to some debt and equity questions. So this is obviously very different from you guys' perspectives, but Andy being a family office, is the question more, is this the right time? Or is it more, we want to make sure and see how this all plays out? And then how do you capitalize your deals when you do find something that you want to do?
Yeah, for us, we have to date just funded our projects with equity from a single family office. We have some larger projects that we are looking to partner with some outside investors on, and so those would be the first times that that we would look to outside equity. And I think the challenge for us and for folks that are folks that are similar to us is that there's the investment world and trying to find money that has a similar mindset and philosophy to you when you literally want to invest long term and just hold. And so you're not thinking about getting out of an asset in 5 to 7 years, and you're just thinking about cash flowing it and continuing to build, a portfolio of cash flowing assets and wealth is, that's difficult. And I think that that's our biggest challenge as we look to these larger projects to try to bring in outside equity, is trying to find people that have that same mentality and who have very patient, long-term capital. That's our biggest challenge on the equity side. On the debt side, we're, as a small company, locally based. Our debt relationships are primarily locally based, like 90+%, and so being locally based, they're primarily relationship driven, and we have really good relationships with our lenders and our locally based community bank lenders. We have mutual interest in growing those relationships. So, debt for us to date hasn't been an issue. I think that we also are really conservative when it comes to debt. Part of that longer term ownership mentality that, we want to be able to ride out any economic downturn or pandemic. So we're really conservative in terms of leveraging our portfolio. And I think a combination of those two things for us has resulted in the fact that debt is, debt's readily available to us. And when we need it, I think we can look to those relationships to, and not really have to stress too much about debt being there or not. So for us, it's more of if we look to these bigger projects, can we find outside equity that can align with our longer term investment goals.
Sure. Tyler, I know the debt and equity markets in April and May were a little shaky, to say the least. How have you seen those come back kind of this summer and early fall?
Yeah. Well, kind of like I mentioned, at the beginning of the call, I mean, we're certainly more active than we've ever been on the development side, and view this as the start of the next cycle. With our group, we pursue all these projects, on balance sheet with our own capital, and so, it's certainly been a much more streamlined conversation internally about, hey, is this something we're really interested in pursuing or not? And we've perhaps been a little bit more strategic and selective about, just the breadth of opportunities that we're kicking the tires on, but the ones that, we are, seriously interested in, it's really been a hyper-focused initiative to try to find a way to, move those projects forward and work towards getting them done. For us on the debt and equity side, we're still on the debt piece. We're still guaranteeing all of our construction loans personally with warm body principal level guarantees, which really has allowed us to attract both highest quality debt and equity providers. We closed our project up in Brighton, in April. With a new equity partner and a new debt partner, right? We started construction. We closed on a project in Dallas in the Uptown neighborhood on a high-rise building there with a new debt partner and a new equity partner, and then we're in the process of closing another project in Dallas in the Bishop Arts neighborhood, with a repeat debt partner and a repeat equity partner. At terms on the debt side that are arguably stronger than pre-COVID levels, just by way of rate manipulation and interest rate compression. So still able to achieve 60-65% loan to cost on these Class A development projects, which is certainly in line with what we experienced pre-COVID, with rates that are pricing out call it all in right around the 4.25 range, right? And so certainly taking advantage of call it a 75 basis point compression to pre-COVID levels. On the equity front, I'd say 80 to 90% of what we're doing is institutional joint venture equity in nature. We do have a stable of high net worth, sovereign wealth funds that kind of fill the balance of that 80% composition. But really the way that we operate our business, just being hyper strategic, hyper focused, starting 3 to 5, 6 projects a year across the country. We've actually been encouraged by our equity partners to go find more and find the next strategic investment for them to put in in our quasi build to core strategy. And so further to that, right? I mean, we've seen most of our equity partners really align themselves with us, in that quasi build to core strategy, right? Where they're sick of going through 6 rounds of best and final on acquisition deals that, just ultimately they get second or third place in, and have become more strategic and saying, hey, I'll just develop into my own acquisition deal. And, there's some risk associated with that, but ultimately the way that we structure that with Kairos, puts us in a really good position to, understand the quality that we're getting. We certainly spend a lot of time involving them and, decisions like naming and finishes and programming and all the other things that, they're going to be interested in at the end of the day once they own the building, for the next 10, 15 years. And so, all that to say, I mean, they've gotten more and more, sensitive to underwriting and have taken, deeper dives into assumptions and comps and proving up, the science behind our underwriting. But ultimately, a good project's a good project. And, we've been able to access both debt and equity capital pretty readily availably. So hasn't been a huge impact to us at this point.
Awesome. Let's move to the construction side of the business. Oh, by the way, we're a little over halfway through on our time. Any participants, if you have questions for myself, for Andy, for Tyler, the Q&A section at the bottom, we are happy to answer those as we go along. So please feel free to ask any questions and type them down there, and we'll try to get them answered. So let's jump to the construction side. Obviously, we were one of the states that continued to allow construction throughout this process, albeit, I believe, at a little slower pace. Andy, were you guys in the middle of any projects, whether it be ground up or TI project for a commercial tenant? How did that go in the last 3 to 4 months? And then are you guys out pricing anything now? And what are you seeing kind of today versus pre-COVID on pricing of any projects?
Yeah, we were in the middle of a couple of projects when COVID hit, both in terms of projects we were building ourselves, as well as some tenants who were building out within our space. And we did see with our own projects, we saw delays. We were past the permitting process or stage for those projects, and so our delays were more related to kind of staging our subcontractors to get in and out of buildings and make sure that there were limited number of people at a site at any given time. And so that delayed us maybe, gosh, the effect of it was probably 2.5 month delay in a project. So not insignificant, but not too impactful either. Again, primarily because if I was doing the size of project that Tyler works on and we had a 60-day delay, that's on a $100 million deal, that's a big deal. Ours aren't quite that level, so our impacts are a little bit less, but it's certainly affected us in our ability to. This happens to be a for sale project that I'm talking about, and so we wanted to hit the market and time it a little bit differently than we're going to be able to. So that's been impactful. And then in terms of the tenants who are building out within our spaces, it's really been more of a delay on the permitting side. We've had really significant delays from the city and county of Denver. And I know, I'm not disparaging them. They're working like crazy, but it was really hard from our perspective to try to get permits and TIs signed off on to get COs and allow people to occupy space.
Yeah, I think that was, there was a lot of things that we heard, but a lot of it was the city and obviously not being totally set up to do a lot of remote things through the construction process and trying to figure out how to adapt to that as quickly as they could. And like you said, I think they were trying to do the best they could, but it wasn't totally set up out of the gate to all be working from home as far as the city goes. So definitely heard a lot of delays there, as well as just regular construction delays. I've heard, a whole crew would get COVID, so then they got to shut the whole project down for a couple of weeks, and that's just part of it. Tyler, you delivered a few projects here recently. Were they delayed? Were they on time? You're pricing out a few projects. How are you seeing that pricing come in?
Yeah, well, candidly, this has been kind of the biggest impact for us, especially as of late. It's really kind of a three-part issue here on just the construction front. Really it's the labor component and making sure everybody stays healthy. It's the safety protocols that are being put in place, sometimes per city standards and other times just for general best practices. And then third, it's just the pricing environment, right? So on the labor front, we did have, one of our workers come down with COVID up in Westminster, and, we had a, call it three-day delay thereabouts just to really kind of, press pause and make sure there wasn't just the rampant spread. This was back in really April, May, so a lot more uncertainty about, the who, what, when, where, and whys of COVID at that point. But, fortunately, above and beyond that, across all of our development projects, under construction across the country, that's really been, the isolated incidents, knock on wood, that, we've experienced. Secondly, on just the safety protocols, programming, we've experienced some cities, specifically Dallas, kind of mandate specific requirements for, call it daily temperature testing, really multiple times a day temperature testing, other safety protocols and programs for random inspections that, have really added anywhere from $50,000 to $100,000 to our construction cost budgets. Certainly not going to kill a deal, but, certainly would rather spend that 50 or 100 grand on cabinets and countertops than, thermometers and, inspections. And so, thirdly, and arguably most importantly, the lumber markets are in complete disarray right now. We have an in-house construction management team that's led by two individuals that have been, doing it for 35 plus years. And, just, it seems like there's multiple emails a week that just say, man, I've never seen anything quite this crazy. This is just unbelievable, ridiculous. And really what they mean by that is the labor, just the rough lumber market has tripled in price over the last, call it, 65, 90 days. And so, really what that means just from a quantitative perspective, our project up in Brighton, is 315 units. We GMP'd that turnkey labor package with our contractor for $5.8 million. And, there was a series of, downstream conversations between GC and sub about, getting that contract signed. And closed out, from call it April to June, July, and, really spare you some of the details, but we've now executed a final, separate framing package, separate meaning, we've got a specific, lumber direct purchase order, and then we've also had to bring in a piecemeal labor installer for the lumber package, where we've now agreed to terms at, about $7.5 million. So, $1.7 million worth of impact, really over the last 120-day period, right? So, no dummy can do the math on, what the impact that is from a rent and pro forma perspective. But it's certainly material. We've seen similar, escalations at our projects in Dallas and Austin that are, experiencing 7-figure plus impacts to lumber market pricing. And so that's certainly something that, we're continuing to monitor daily. Hopefully we'll get some relief here over the coming months, but really the weekly letters that come out from these lumber mill suppliers, really show no end in sight of when this, cost relief is going to occur. And then, really further to that, we've started to see, some piling on of sorts with, flooring, suppliers, appliance manufacturers, fitness equipment that have also come out and said, hey, not only are we going to, not meet your schedule, but we're also going up, in pricing 8 to 12%, which again, you just, death by 1,000 cuts, all those things just continue to, make these deals, tighter and tighter. And so those are all, part of the realities of developing anything across the country at this point. And, candidly, something that, we're a little bit more anxious about, just in light of, what happens when drywall and painters and, masonry, folks start, catching wind of, all these increases. Why not just pile on, with them too, right? So, there's certainly been a noticeable impact. And then, just lastly, we've also seen, complete disruption in the insurance markets, with premiums, up close to, 40% year over year in terms of both builder's risk and operating, liability insurance. And so all those things, again, just kind of harken back to the comments about, rents in the Class A space pre-COVID up 1%. You start sprinkling on these, radical, increases in cost, you really just kind of, start to look in the mirror and say, man, what's next? And what does this look like, a couple of years down the road? So all things that we're certainly, keeping our pulse on, very, very, intimately.
Perfect. We got a couple of questions from some audience participants, so I want to jump into that. Andy, this is for you. Could you speak more to the social attributes in development project as your company is looking to achieve?
Yeah, sure. I mean, for us, it's varied by our project, really. I mean, it's not a one size fits all kind of thing, but really the net of it is, we want to make positive impacts in the communities where we're investing, and we're members of that community. So whatever we can do to try to achieve both of those goals, economic and social, at the same time, we go out of our way to do that. So I'll give you some examples. Like in our, it could be very simple. We have a commercial asset in Rhino where, we try to encourage local first-time business owners as our retail tenants, right? So, as opposed to just maxing out rent based on what other folks are doing, we're trying to encourage first-time business owners, to be there. And so sometimes that comes in the form of lower rents or, less security on, the leases that we have in place. We've tossed around, haven't yet implemented, but tossed around ideas of taking, a particular space and identifying it as, kind of almost subsidizing it. So, we can find women-owned or additional women. We have many women-owned businesses in our communities, but maybe it's women-owned, maybe it's minority-owned or Black and brown skin-owned businesses, and really try to help them provide an additional leg up for those businesses. On the residential side, we have a project that we're currently in concept for, where we want to make it affordable for teachers and for firefighters. And so we won't be maximizing amenities. We won't be maximizing rents in this building. We're going to try to make it an affordable place that, you know, people can live in the city and county of Denver, who work in the city and county of Denver. And part of that, you know, or the additional part of that we're looking to do is establish a trust whereby a portion of their rent would go into this trust that would, when they leave the community, they could effectively use that money to make a down payment on a house. So it helps them, again, with a step up towards home ownership. So it kind of depends, but it's really comes down to trying to make positive impacts in any way we can and still achieve kind of both of those goals in terms of social impact and have a stable economic impact for ourselves.
Very interesting, Andy. Question for you, Tyler, just for a clarification. So when you're saying 65% LTC, are you and your partners coming up with the rest of that just as pure equity?
Yeah. So yeah, we're the capital stack for us is 65% loan to cost. And again, you know, very similar to other, you know, institutional type models, we're doing joint venture equity agreements that really, you know, have 90-10 or 95-5, you know, LP, GP, you know, co-invest kind of split. So generally speaking, we're you know, co-investing, you know, 5 to 10% of the remaining equity after the debt piece comes in, right? Just depending on the partner and the deal about, you know, where that falls on that spectrum. But generally speaking, we're bringing 5 to 10% of the equity required plus, you know, all you know, construction debt guarantee requirements.
Perfect. A couple of last questions that I have, and audience, feel free to ask any more questions that you like. But you know, obviously, there's a lot of news articles, and the ball's, you know, this wave of evictions is coming, and I think I think that's probably very market driven. Even in the metro area, we've got a lot of different pockets that are probably experiencing more hardships than others. But Tyler, I know you and I spoke about your Uptown project. Can you just speak to the lease up of that? How's it going? Are you hitting your projected rents? Are you, you know, having to give a little more concessions? Like, you know, everybody says the top end of the market is struggling, and it seems like you guys are doing pretty well with that particular project.
Yeah, I think, well, relatively speaking, but, you know, I guess the short answer is it stinks, you know, across the board. You know, velocity's down, you know, lease up velocity's down, rent rates are down, specials, you know, and concessions are way up. So yeah, it's not a fun conversation, and really, you know, disappointing just from a timing perspective, right? Obviously you put, you know, 3, 4, 5 years into a project and deliver it at the worst possible time in the history of deliveries. And so what that really means for us is, you know, we're having to give away anywhere from 6 to 8 weeks free, just depending on the unit type and the location of the unit within the building. You know, what we're performing on, you know, pre-COVID performing, you know, 20, 25 units leased per month for these Class A, you know, development projects. You know, during COVID, we've averaged about, you know, 8 leases a month, right? So, you know, that in turn has led to some candid conversations with, you know, lender about, you know, what do reserves look like just from a construction loan interest perspective, and how do we recalibrate that appropriately? What does our forecast look like, you know, through the end of the year, and then, you know, into the first, second quarter of next year, you know, ultimately until stabilization. So, yeah, you know, you hit the nail on the head. The Class A space has certainly been a highly concessionary market. I think there's been a lot of, you know, type 1 high-rise buildings that have been delivered both, you know, in Golden Triangle and in Arapahoe Square that have really hamstrung the market a little bit in terms of just, you know, the specials that they're having to offer to get full just so they can get occupied and, you know, satisfy their, you know, capital requirements, right, that have really pushed down just the ceiling and the floor, depending on how you look at it, of other buildings in town. You know, when you can go live in a high-rise building for, you know, $2 to $2.20 an effective, you know, square foot, I mean, that really is going to put a ceiling on what the other you know, bona fide high-rise buildings can achieve in terms of rent and location, right? So it's been tough sledding. There's no question. We've started to see a little bit of a rebound from a velocity standpoint, you know, really over the last, you know, 6 to 8 weeks, but as we all know in Denver, right, once you really get past Labor Day and you start moving into the winter months, right, I mean, leasing and rates, really have strong correlations, in a negative fashion moving forward. So it'll be interesting to see kind of what, call it the lower, seasonality impact of what we've experienced in Denver over the course of time will dictate with COVID sprinkled in.
Perfect. All right, final question for both of you. So we've had historic amount of new deliveries on the for rent side in Denver in the last few years. Obviously, projects like Tyler just mentioned. I mean, projects that are delivering today or even the next 12 to 18 months have been in process and worked on for years. So I'm going to kick this question out for more. I would call it 2022, 2023. Do you think we're going to see a significant decrease in deliveries coming up in those years? And why? Andy?
I personally don't think the actual volume, the number itself is worrisome. I think kind of to parallel or to echo some of that sentiments that Tyler was speaking to, I personally don't feel that the type of product that everyone wants to deliver, because that's where the rents are and that's where you can kind of show pretty significant returns to your investors, that Class A, highly amenitized, expensive product. I personally think that there's a cap on that product in terms of what can be delivered. That said, the type of product that we would look to invest in, whether it's through development or acquisition, would be more of the almost working class product. And I just, given the net in-migration to Colorado, I don't really expect to see that lessening in the foreseeable future. So I wouldn't worry about the total volume of deliverables or deliveries, but rather the type of asset class that gets delivered and how that's positioned in the market.
Tyler, same question.
Yeah, I think, again, we've been so wrong during 2020 before, and, probably might be wrong here, but I think logic says that it has to, deliveries have to fall, right, with just, the realities of the cost of sticks and bricks, at all-time high, coupled with rents, at call it 2000s levels, right? I mean, those just simple economic relationships are completely dislocated in terms of just financing and, abilities to, get the volume of projects, financed and under construction that we've seen over the last 5-10 years in Denver, right? Certainly still, confident that, strong projects will continue to move forward, but, we view that some of those marginal fringe, projects that, may or may not have gotten capitalized during the great financial crisis, we'll probably see some of that here too, where, we'll see folks pass on the debt and equity side for those projects that are just kind of on the margin, so to speak. So I think that logic says it's going to have to slow down. But again, we've seen, permits in Denver fall, upwards of, close to 40%, each of the last 2 years, right? But deliveries have really held strong. So, you think that moving into 2021 and beyond, right, that, you're going to see, some, clearing of the deck, if you will, on just new deliveries that are hitting the market, just, based on the pause that we're experiencing currently with a lot of projects and presumably what will happen here over the next, 6, 12, 18 months, right? I think it has to, slow down a little bit.
Yeah, no, it's great. Well, that's kind of our time. Thank you both very much for coming on. Some great topics there. If anybody has any further questions, feel free to reach out to me directly. If you have a question for Andy and Tyler, they're both accessible and great guys and know what they're talking about. So feel free to reach out post this webinar. And thank you again, and everybody have a great day.
Thanks for hosting, Adam. Thanks for the opportunity.
Yeah, thanks, Adam. Thanks, Andy.
Yeah, see you, Tyler. Thanks, guys.
Thank you.